about our European fundraising market, and I didn't get a response. So I was sort of complaining and writing him an email and said, you know, what is it? And then he was explaining to me that it's his group that he built up over years with a lot of personal investment and time and contacting people. And I said, that's fine, if you tell me that, and I know it, you know, I cordially invite you and have you speak at our conference. So I'm glad he's here, and he told me he's living in Brazil and in Portland, Oregon, and now the stage is yours. Tell us about the family office.
Great, thank you. So today, my goal is to share basically within 30 minutes everything I know about what family offices are looking for while investing their capital. This is something that I think is of interest to many people because most fund managers I know have a few investors that are family offices, but it's happened kind of by accident or through a friend or through a long-term business partner. And many people see the family office area as kind of this gray mass of investors that's a little bit hard to navigate. So hopefully this presentation will help. Here's the standard disclaimer. First of all, my perspective, we run actually 3 alternative investment related associations. Our family offices group is our Family Office Association. It has, as of today, about 25,000 members, getting close to 30,000. Our Private Equity Association has 55,000 members. Our Hedge Fund Association has 55,000 members. So well over 100,000 total members have joined our associations. People do this because it's free to join. It doesn't cost $3,000 a year. And we give away thousands of articles, videos, and audio interviews we conduct over the phone that are recorded. For example, I recorded a few videos on family office best practices outside the castle yesterday. In Zurich, we recorded some from the university, and basically everywhere I travel, Singapore, Tokyo, or Brazil, we record videos that help people understand how family offices work, how the hedge fund and private equity industries work. And I don't know about you, but about 7 or 8 years ago, when I was really trying to learn about family offices, I just found it very hard to find any reliable information that was written on family offices, unless it was a journalist on some recent trend. It wasn't really educational. So that's kind of our mission, is provide almost consulting level quality or almost university course level quality information on alternative investments and family offices, and do so in an easy to consume video format, blog posts, stuff like that. And it's been working very well. We also run some training programs. I don't want to spend part of the 30 minutes on here, but if you visit our websites at hedgefundgroup.org and familyofficesgroup.com, you can learn more about those if you're interested. What I'm not an analyst or portfolio manager. I'm not a compliance expert. Most people that I end up speaking to at conferences are experts in risk management or portfolio management or trading. I'm an expert in marketing and capital raising, so I'm happy to answer any of your questions either at the end or while I'm speaking if you have something come up. Our business is based in both Sao Paulo, Brazil and Portland, Oregon. We work with clients around the world. Our team is made up of about 20 professionals, and 7 of us are working full-time in the business. Here is something, again, not to spend much time on. You might recognize a couple of the symbols, the Hedge Fund Group logo or the Family Offices Group logo. And there's some books that we've written at the top of the website page there. And the first thing I want to talk about is how central CPAs are to the family office industry. Many people, like private equity funds that want to get capital from family offices, will sometimes go speak at private equity conferences. And I think that can be a great way to see what your peers are doing. And some family offices do attend private equity conferences to get new ideas of people they should be working with. But I also think that you should pay very close attention to CPA associations, accounting associations, and people that are going to be advising the ultra-wealthy, because I think that that's another source of potential investors for those trying to reach family offices. Because then you're not only speaking to your peers, you're also speaking to your actual target market, or a room full of people that can actually refer you to these ultra-wealthy people that really work on referrals most of the time. Just to start off, what I found concentration of them. In my experience, some of these places are Monaco, Switzerland, nowadays Singapore, New Zealand to a smaller degree, Panama to some degree. These are some growing hotspots, but really the industry is very diverse, and that's great news for those of you trying to raise capital, in Germany or within the EU, and you don't want to have to travel to Singapore or someplace like that. The top 5 things that are growing family offices. I think this is important to know if you're looking to work with family offices and gain investments from them, because you can kind of understand their world and what challenges they're facing in running their business model. The first thing is that during the economic crisis and the current, debt crisis, you could say, many family offices are lowering their standards for bringing their clients in-house. Many family offices that I know and have worked with used to require 30 and 50 million in assets to join them. Now they're requiring 20 million and sometimes even 10 or 15 million. So the whole definition of what a family office is versus a wealth management firm is just becoming a bit more cloudy in terms of the asset levels required. But it is growing the size of the industry, even though it might cause some confusion. A couple other things that are raising the level of family offices in the world is that wealth management firms want to call themselves a family office, so they'll tack on the words family office after their name to kind of add some cachet to their offering. So again, that's adding to the number of family offices out there. Many people at trusts and private banks have 1 or 2 very high-end clients that are not being serviced like they should, because the client manager might be tied to cash management options the bank offers. It might be tied to fund managers that have gone through the 2-year approval process of the trust or private bank, and they might not be nimble enough to really serve that investor. And if the investor has 300 million or 500 million in assets under management, they typically could afford to say, I like how you've been giving me, you've been listening to my needs and serving my needs, but I know that your hands are tied being this private bank, so let's form our own single family office, or let's form our own multifamily office. And many times that's how most family offices I've found are formed, either by pulling out a CPA and getting them to start a family office with them, or from a private bank or trust. I think that's important to know, just to know who you're dealing with when you go and meet with a team of family office professionals. Typically it'll be the patriarch or matriarch, the person that launched the family office, and they might have an accounting background. And I think that changes how you present ideas to them if you want to get capital from them. The last thing here is just about number 3 and 4 here are about how global wealth is growing even within crisis times. The amount of people who are millionaires and billionaires is growing every single day. And I believe that about 20 years ago, very few people in general society knew what a family office was. And even nowadays, I say that I work with family offices, and some people, even in the finance industry, don't know what that is. They're confused by that term. If you look at the term hedge funds, 30 years ago, not many people knew what that meant, but some people in finance did. 10 years ago, the general public started to see things come up in the newspapers, usually bad things about hedge funds, but the general public now knows a little bit about hedge funds, and everybody in finance knows what a hedge fund is. So what I'm saying here is that if you look at the parallels with hedge funds and family offices are just now starting to be recognized by the general public as being understood what their function is and what they do. And in places such as Indonesia and Malaysia and Brazil, where massive amounts of wealth are being created every day, these types of terms, people knowing what they are, is very important for the growth of the industry. That's happening right now. Family office investment committees change based on whether it's a single family office or a multifamily office. Many family offices don't have an official investment committee. It's kind of an ad hoc meeting they have once a day, once a week, once a month. At single family offices, that's even more the case. And oftentimes on a single family office investment committee, you have outside advisors actively participating in the committee meetings, where in a multifamily office, it's almost always closed door, unless there's one CPA or one global tax attorney who's known the family office or known the family for a very long time. I think that's important to know. And I think that some of the most institutional family offices are forming 2 different investment committees. They have a strategic one, which meets less often, maybe once a month, maybe bi-monthly, and then they have a tactical investment committee that's very nimble, usually smaller, 3 to 4 professionals, and they can adjust to note before I go on that a lot of this is based on my personal experience in working with family offices, in representing them and bringing fund manager ideas to them. But also, this is based on my work right now. I'm actually writing a book on family offices for Wiley Finance. And the book basically is based on my 36 phone-recorded audio interviews I conducted over the last 2 months with family offices, both single-family offices and multifamily offices. And I interviewed a dozen single and about 20 multifamily offices, recorded all the interviews, I have all the transcripts now, and we're publishing it as a book basically on how these top family offices that manage billions of dollars are investing their capital right now. And some of this advice has been tweaked since I did those interviews, even though I've been working with family offices and I run an association on them. Speaking with that many in such detail about how they run their investment committees and how they run their family office was a unique experience and something that doesn't always come up when you're meeting with somebody to sell an investment or work with them in a different way. Investing priorities, this is probably the most important page here for those of you that are trying to raise capital from family offices. Some of you might already be familiar with this, but the main function of a family office I've found around the world is to preserve capital. Some single family offices, first generational wealth family offices might still have a more aggressive growth perspective on the role of family office, but I find that 85%, 95% of all family offices put capital preservation first. Growth second, and taxes usually third or fourth. I found that the term that often came up is they don't want the tail wagging the dog. They don't want to have a tax-efficient structure that loses 20% of their principal. So the first thing to look for is protecting the principal of their investments. And I think that's, if you're like me, your role as a capital raiser is pretty critical to know because that will change what you present in a meeting or what you emphasize in a meeting and could change their perspective of who you are and what you're doing. Income is the other interesting thing on this list. It's kind of hard to put in order with income. So what I found is that family offices or individual wealthy families with 100 million to 200 million in assets are more sensitive to the amount of income they have and the income requirements. And especially families with 20 or 50 million in assets definitely have income needs as a percentage of their total wealth that are more significant. Whereas if a family has $1 billion in assets or $2 billion in assets, like several of the single family offices that I interviewed, the income concerns are relatively negligible just because the percentage of that total portfolio that needs to produce income, if you diversify across different types of alternative assets such as core real estate, naturally you're going to produce some income that should be spun off. It's just less of a top 3, top 4 type concern. So it really depends on the size of family office that you're working with. I think it's important to know that family offices, most of you know that most family offices are formed either from an entrepreneur taking a company public or selling a business. You can inherit money, or maybe you're a TV celebrity or a sports star. Most family offices are based on selling a business or some sort of liquidity event. And because of that, family offices are very entrepreneurial. And what I found is that most people who come to me looking for help in raising capital from family offices, just because of the dynamics of our industry, 80% or 90% of the fund managers out there have less than 50 million in assets under management or less than 100 million. And if you want to work with family offices and you only have $1 million under management or 10 million, oftentimes looking at partnerships is one of the best things you can do. Family offices know that they have more money than high net worth individuals or wealth management firms, and they want to use that to their advantage. And they want to use their capital to get special terms, to get a percentage interest in your fund possibly, in the actual fund management company, instead of just investing like every other type of investor. They're looking for ways they can use their capital advantage to manage their downside risk and get some sort of outsized returns on the risk they're taking, which is what every investor tries to do. But knowing that family offices are open to entrepreneurial ideas, I think is really crucial to working with them, because many times people can see it as quite daunting to raise capital from family offices, but they're just not thinking creatively enough, or they go into it, saying our minimum investment is €5 million, 5 million francs, and they don't go into an open mind of how they might be able to partner with the family office long term. So I think that it depends on what size you are, and what stage you are in the life cycle of your fund management business, but you really do some creative things. Internally, Many of them come up with their own creative business factoring schemes where they help finance businesses' receivables. Many times they invest in multifamily apartments in real estate. I found that very common. And many times they make direct investments, like we heard from a few of the pension fund professionals earlier today. And I think all of this is just really important to know if you're trying to raise capital from family offices. Part of my experience in this space is actually running hedgefundseeding.com, which is we represent a couple $billion-plus institutional investors that are always looking for fund managers, and we help source those. And that's part of how some of my knowledge comes from this whole area of partnering versus just trying to raise capital in a traditional way. There's a few things that family offices look for, whether you're a private equity fund manager, a REIT manager, or a hedge fund manager. The number one thing that came up again and again within all of my interviews and my experience is just that the pedigree of the team, the quality of the team, the depth of the team is of utmost importance. Many times family offices would rather invest in a great team with maybe only 3 to 6 months of a track record rather than invest in a mediocre team that's been returning 25% a year for the last 5 years. Many times they realize that if they get the wrong team in place, in this type of volatile marketplace, that could be the most critical mistake. So they see this as the most important mistake to avoid and the most important thing for them to focus on. So I think the lesson here for capital raisers, if you're trying to work with more family offices, is build the deepest team you can possible. And if you're saying to yourself that would be great once we raise $1 billion, right now we can't afford that, a good way to kind of work around that, I think, is to build a very robust board of advisors, because that will show that these people on your advisory board trust you. They're putting their name on the line by being associated with your fund. And lots of family offices and very experienced professionals I know will serve on an advisory board with no compensation at all. If you require their time every week, I'm sure they will with compensation. But many times, advisory board members are not compensated, and they're rewarded in other ways. You might have other types of resources you can connect them with, or maybe they're looking to grow their own kind of bio or credibility in the industry in some way. So I think the board advisory solution is something that some fund managers don't focus enough on when trying to build their team in a cost-effective way. Crystal clear advantage, and I touch on it in a few minutes, so I'm not going to spend time on that right now. But having an institutionally aligned structure with really long-term incentives and reporting is really important. What's to keep the number 2 and 3 people at the team over the next 5 or 7 years if they don't own any of the business? You should have some vested profit plans or something that's in line with the regulations where you operate, where somebody might earn a certain type of bonus, but it's not released until 2 or 3 or 5 years down the road. Or maybe part of their bonus is based on the fund still performing well those next few years. There should be some really long-term incentives, because that's what family offices are going to look for. If they spend a year and a half doing due diligence on your fund, they want to know that a year and a half from that point, the same executive team is going to be there. I find they care much less if one analyst leaves, and everybody knows there's a lot of turnover in our industry. But this is, number 3 is a point that I think is something which doesn't cost a lot of money. It just takes some concerted effort, some thinking to make sure you have these plans in place for your team. A couple of other interesting findings was that almost every family office I spoke to said they don't work with managed accounts very much. Many times the cost and the work needed to do that is just not worth it. I think only the largest, maybe the top 5% of family offices would require that. And we actually interviewed, or I actually interviewed 5 to 7 of the top 30 family offices in the world. Many of them serve 500 families, 300 families that all have 50 million plus in net worth, or 100 million net worth. And even those family offices, many times are not requiring managed accounts. So while this is a best practice and can earn rewards, I know in the pension space, family offices, it's not really there right now. It's open, it's an option, but unless there's allocations of 100 million plus going into a manager, many times it's not even considered. Consistency is important in your risk management and your investment process. I think everyone knows that. AUM levels, many times if you're under 100 million in assets, it's very hard to raise capital from family offices. But as I said, if you're open-minded and creative, it can be done. And Track record's important, so I put it on here, but I put it last on purpose because really that's something I think is a bit counterintuitive. Some people don't start trying to raise capital until they have a 7-year track record. And I raised capital for a manager who's done that before, and it's hard work because then you don't move up the learning curve, and you don't know what you don't know. And if you start raising capital at year 7, your marketing materials look like you're at year 1. So I think it's important to raise capital early on before you have a long track record so you can move up the learning curve and start growing your contacts. Types of funds that managers, that family offices like, really they're open to all different types of funds. They want to be diversified across asset classes. I found that many use ETFs as an efficient way to get some beta exposure. They like hedge funds because of the liquidity, but the returns they can get based on the risk they're taking. Obviously, private equity has unique returns if you choose the right funds, so they have an interest in that area. And separate managed accounts are used, I've found, more often than mutual funds in terms of separate managed account managers, like long-only managers. And this slide isn't the most exciting, but I just wanted to run through this real quick to show you that ETFs are used much more often, in my experience, than mutual funds by family offices. And they do invest across the full spectrum of investments. Let's see real quick. Actually, shorten the presentation a little bit to make sure I wouldn't go over. I think there's a couple extra slides in here. One strategy for raising capital from family offices is something called the horse betting strategy. There's an expert in the science of influence and persuasion called Robert Cialdini, who's written a popular book called Influence, the Science of Persuasion. And it's really about effective communication and marketing. And one thing that he discovered is that in research studies that have proven that the minute that somebody places a bet on a horse in a horse race, their confidence that that horse is going to win dramatically rises, far more than it was before the bet they won money on the horse. And that's logical if you think about it, but I think you can use that to raise more capital from family offices by not demanding that people put in $10 million as kind of a test investment. You're not saying your minimums are 5 million francs. I think that if you can get people to invest a very small amount in your fund, even if it's $500,000 or a million francs, as long as you have that type of capacity and are able to deal with that many small investors, it can lead to people being more confident about your team and more of an internal champion to their investment committee. It's less risky to test you out that way, so many times that's what family offices are interested in. This is just kind of one strategy to kind of apply some of the things that I'm speaking about here and actually use this knowledge for capital raising, being more effective in working with family offices. Crystal clear advantage is probably the number one piece of advice I would have if you're looking to raise capital from family offices. We heard from multiple venture capital and private equity funds earlier today. One has an advantage of exclusive access to university research. One has such a global team and resources, they can leverage that and produce greater returns and cost savings on their investments. Another one kind of combines the benefits of angel investing with venture capital so that they have a crystal clear advantage. And I think that's excellent. Most of the funds I speak with face-to-face, I speak with and train over 1,000 hedge fund, private equity fund managers a year. And we have over 100,000 members in our associations. And I can tell you for sure that over 900 of those 1,000 I speak with have no crystal clear advantage. Most of the time, especially in the hedge fund industry, people like to say, we have a diversified approach or diversified portfolio that's uncorrelated with the general markets, and we have absolute returns, and sometimes in a down market we do even better than in an up market. Everybody says that same sentence, and family offices just kind of, glaze over and just wait for the pain to end and say thank you, we'll put you in the database. And they say polite things like we'll be in touch. And they came up again and again. That was my experience in capital raising personally, but also it came up again and again in the interviews that family offices, if I speak with 1,000 fund managers a year, and I'm not controlling hundreds of millions of dollars in capital or billions, family offices get a multiple of inquiries that I get. So whatever feelings I have, important to know exactly what is different about your fund, and if you drill that home with everything you do, your logo should represent what's different, your team should represent what's different, your first slide of your pitch book when you're on a due diligence phone call should emphasize what's different. Everything you do should be aligned about what that crystal clear advantage is. So if somebody leaves the room, maybe they'll say something about not liking your team, or maybe not liking, strategically allocating to what they're focusing on. Maybe they'll say that. You can't control that. It's not going to be right for every type of investor. But you want to make sure that when they leave the room, they know exactly what your crystal clear advantage is. And I would say this alone would put you above 70% of the other capital raisers that are trying to raise capital from these same investors, family offices. So it's something that's really critical, and I don't think we've thought about or refined or integrated in everything you do enough. Should probably be in your one line on your business card exactly what the crystal clear advantage is of your fund. Long-term thinking is critical. The time horizon of investments for family offices is very long. They like to have some of their investments be liquid for obvious reasons, but they invest over a long period of time. That's why they have some interest in private equity as well. And I think the side of this, which is not totally obvious, is that everybody in our industry, whether it's wealth management, private equity, or hedge funds, talk about how pedigree and teams are very important. But almost nobody really breaks that down, besides your gut feeling of whether you trust someone and they worked at some big name bank. What does it really mean that they have a great team? And I think part of that comes down to character. And there's a quote, I think it's by Brian Tracy, that says the degree of character someone has can be measured by how expedient they act. So somebody acts very quickly to get what they want. And for example, if I wanted to speak at this conference and I wanted to act very quickly to speak at every family office conference, I could go around and just pay $10,000 to speak at every conference without doing my research or without naturally getting that opportunity, and it would show a certain degree of character. Whereas if you do things kind of the slower way and the long-term way, and you plan things for the long term, it shows that you're not going anywhere and you're invested in your own success, you're invested in your business, and that, like the family office, you have a long-term time horizon for your business. A great example of this that I brought up earlier is your team. If you have team incentives where everything is based on 6 months or 1-year bonuses or compensation, it's going to show, or maybe some of the people that are on your team are really contractors and they're not even full-time employees at your fund, and people find that out. It just shows you're kind of running this for the short term. You're not really investing in your own business, so why should they invest in your business? So everything you do has to show that your time horizon matches the family offices, and you have a very long-term bias, not only because that's how they think, but I think that subconsciously, or whether people have thought a lot about this themselves, about how they judge the character of the teams they're investing in or the funds they're investing in. It's just really important that you show that you're in this for the long game and you're not trying to make some great returns and produce 4 times return on cash, or produce great performance fees and then cash out and close down the fund. These are some of the credibility symbols that our team uses in working with family offices and gaining the trust of markets and people that might invite you to speak or invite you to meet with their family office. This is something I found helpful while raising capital, to write a book for Wiley or get quoted in the Financial Times. So this is more of a capital raising tip for those of you who want to access family offices. People judge pedigree and team depth based on the brand of the bank they work for, or based on who published their book, or based on where they went to school. So people look for tangible, explicit things. It's not, I think that sometimes character to family offices, you can provide helpful resources to family offices. That's why we started the Family Office Association. And that's why I speak conferences like this. That's why I'm writing the book, is we have a laser focus on providing as much value as possible to family offices. And it's because everything's done based on referral and trust. So it's important to figure out how, with your strategy and your crystal clear advantage and resources, you can get fit into the web of the family office industry. I think it's important that when you meet with a family office, you ask more questions and pitch less. Many times on a due diligence phone call, people open up a PowerPoint, you go through it over the phone, might last 45 minutes or an hour, and usually the whole time you're pitching, maybe trade off and have different executives speak. But in the end, you say you have any questions, and somebody might interrupt you with a few questions, but people wait till the end. I think that you need to ask questions more than you speak. When you go meet with a you have to figure out exactly what size of family office you're going after, how you're going to add value to them, and combine that with your crystal clear advantage. So how exactly